Good morning. Thank you for joining us for today's webinar, Liquidity Considerations, Preparing for What's Next. My name is Sean O'Brien, President of QuickRate, and I'm pleased to be joined today by Pam Sarubi. Pam's going to take you through a walkthrough of the marketplace in the second half of the presentation. A couple of reminders before we get started. We will send out a link to today's recording or of the recording of the webinar, along with a copy of the slides. It will likely go out in an email to you tomorrow afternoon or early Friday morning, but we will be sending those out with, again, a link to the recording and a copy of the slides. So just to kind of get started and kind of, frame up a little bit where we are, right? I think most of us probably started the year and, we certainly have been monitoring just kind of where the economy is going, right? There's not a lot of noise around tariffs and where interest rates are. And I think as we, headed into at the end of the year and in the start of this year, a lot of focus is on, where rates would be. And a lot of that depended on, what the outlook for the economy was, right? And I think the three areas where most people kind of focused on was, where rates just kind of continued to stay higher for longer and inflation remained sticky and the rate cuts were delayed. The second camp was, a softer landing where we see inflation continuing to decline so that the Fed can begin lowering rates. And that's kind of, what feels like starting to happen. And the third choice is that, we just have a hard landing where, employment would kind of, pick up lower rates and, stimulus would be needed because, things were going to really, slow down pretty dramatically. And so, I think we've, kind of been in the, seeing, kind of in between no landing and soft landing where things are. I think at the median, we'll have some second quarter numbers here for the industry, obviously, as everyone's filing their call reports this month. But, I think, again, as we looked at the where things have started the year, growth has been pretty, kind of across the board. We've seen a little bit of asset growth, a little bit of loan growth, and a little bit of deposit growth. I think, we have seen reliance on CDs for funding for most banks continuing to go up. I think, fortunately, we've seen yields on loans continue to rise. And I think a little bit of the urgency around deposits, has slowed, and that's allowed us to, for most of us to see a small, decrease in our cost of funds, which is certainly encouraging. NIM has been up, which has been great. Obviously, with the 10-year higher, mortgage activity has been slower, so non-interest income's been down. But again, I think across the board, core operatings for most institutions have improved. We have seen charge-offs tick up primarily in the not really at the median as much, but just a little bit overall in general. Reserves have gone up to kind of meet that, and ROA and ROE is up. So again, I think it's been kind of just a steady as she go start to the year, which is great. But I think it's something, again, I think we've all kind of benefited from. Again, I think for the most part, certainly at the median, the majority of banks have seen deposit growth. They do remain expensive, but the pricing certainly been competitive with market rates. But we've all been able to kind of digest that and keep our cost of funds lower than they were this time last year. As we do often here, we just thought we'd start off with a few polling questions. So I'm going to grab those. Certainly your participation is welcomed. Just 4 quick questions. One of them is really just, again, whoops. All right, let's try it again. That didn't launch. All right, well, no, my polls aren't launching. So let's see here. We can try another way. There we go. We'll start with the economic outlet. Let's see if we can launch this one. Oops. I'm not sure if you can see it, but what is your economic outlook for the next 12 months? Soft landing, hard landing, or no landing? I don't know if that is. Nope, it doesn't look like it's going to work. Okay, so we're going to skip on the polling questions for today. Again, I thought what we'd start the first half of the presentation is just, again, kind of around liquidity. I think you always start with kind of the definition when you're telling the story. Just the ability to raise money at a reasonable cost without principal loss. And I think, what we've seen over the years, right, is, I think we always feel pretty good about our liquidity until we don't. And so, I think it's just today is just a kind of a fresh reminder on articulating our liquidity story and how that kind of works their way through our institution. I think in conjunction with that is we want to continue to stay close with our deposit base, right? A lot of our liquidity policies really focused on wholesale funding and external sources, sources of liquidity. But really what, is at the heart of obviously what we do is maintaining a very strong local deposit base. I think, again, given, the past couple of years, I think further emphasis has remained on communicating with our largest customers. I think certainly establishing or monitoring, attrition rates has become, a little bit more important. I think we have seen in many instances, we are willing to allow single relationship accounts to leave. But I think, we've also recognized that we have to kind of price our accounts with a little bit of discretion and, recognizing clients and customers we want to retain and those that we are at a certain price willing to let go. I think when we're kind of flush with liquidity, sometimes I think we can allow ourselves to a little bit relax in terms of liquidity risk management. But again, I think it's just a reminder that in these times when we do feel a little bit better about our liquidity, is the best time to kind of review and refresh just our approach, just to make sure everything is in line, because you don't want to do that in the midst of any turmoil. So this is always, again, I think just a good reminder to kind of refresh and optimize and prepare for, for what could be, times ahead where things might change. I think at a minimum, I think what we might be looking to prepare for next is, deposits in a declining interest rate environment. We've seen them, obviously, interest rates tick up here, and now we may be at a time where we've plateaued and maybe the next move is lower. So again, we always want to make sure we're optimizing our wholesale funding. We want to make sure we're pricing all of our deposit sources effectively, blend active and passive pricing. Certainly for core deposits, a little bit maybe more passive pricing. For those rate sensitive prices, deposits, actively pricing them a little bit quicker. Certainly looking for the opportunity to reward our best customers. So creating products that, we can leverage tiered and relationships is certainly, critical to that endeavor. So again, I think when we start thinking about talking about your liquidity story, where are you today in terms of your deposit base? Is it growing, or are we seeing some, still seeing some attrition in our local market? I think defining how much cash we want to maintain on our balance sheet for daily inflows and outflows. Reviewing all of our wholesale funding sources. Again, not trying to concentrate on one or two. I think having multiple funding sources at your disposal is important. Reviewing your collateral, making sure you are incorporating all available collateral and then optimizing it either with the home loan bank or the Fed, or even a third party, maybe a banker's bank or a correspondent bank. And then, again, kind of flipped on its head. We've always kind of looked to our bond portfolio. Many of us may still be experiencing, an AOCI adjustment in there. So maybe that's not the ready source that it's always been. If you do have that, then obviously, or don't have an AOCI adjustment, then we're obviously looking to our bond portfolio to see what kind of liquidity that could allow or afford us. I think incorporating stress testing, or just, having some KPI monitoring to make sure you're aware of when things might change. And then ultimately it all kind of gets encapsulated in a contingency funding plan. So again, starting with cash collateral, bond collateral, home loan bank, and FRB collateral, and your funding sources. Really, these are our pillars of our total liquidity. Being prepared. What could change or adversely impact our liquidity is really what we want, right? We can tell the story of where things are today with these four components, but we really want to make sure is that what would start to change that again we might want to be a little bit more prepared for. And I think that starts with meaningful policies and procedures. So as we've said many times here, we want to make sure our policies don't restrict us. So again, incorporating as many funding sources as you can, giving yourselves, I would say a little bit expanded limits on how much of that wholesale funding you might incorporate, or how much FHLB borrowings you will incorporate those. Just don't restrict yourself, because again, what we've seen in the past is that in times of trouble, you go to change your policy and into an examiner, or it just might indicate, hey, why weren't we ahead of this? Why did we not have this in place before trouble? It says maybe it suggests perhaps we weren't kind of incorporating enough forward-looking scenarios that where we thought we might need more. So I just always think start higher, give yourself the flexibility. Hopefully you won't ever need it, but you've always had kind of the worst case or the doomsday scenario in place by giving yourself more flexibility. And then certainly, begin to measure and monitor those KPIs, that would indicate any potential levels of stress where you might start to look to activate a contingency funding plan. I think in a lot of institutions, I know in the small bank where I'm a director, how much cash we should have on the balance sheet seems like it's an ongoing discussion. But certainly, managing that to your bank's comfort level, certainly mindful of month and quarter ends where the draw might be a little bit higher. Again, your bond portfolio is where we've often always gone first. If that's available to you, that's great. And then identifying those securities that you might move first. Again, I think increasingly, I know we've been on a little bit of a kick to make sure and suggest that all banks, I think traditionally have always had FHLB relationships. I think the Fed has worked to minimize or reduce the stigma about having a borrowing relationship with them at the discount window. Again, I think from a planning point of view, you should have both and then optimize both, right? Depending on the type of collateral, the FRB, the Fed it takes a little bit more expansive forms of collateral. So again, evaluating what you have and what you might be able to pledge, I think is an important element to telling your liquidity story. But I think just a healthy process to continually review to make sure you have all the collateral pledged that you could. And then if any of it's been audited, right, is any of it not going to be acceptable, or has that changed? The risk rating has changed. And then just understanding the timing of those, draws if and when they are needed. Again, being prepared, as we mentioned, incorporates utilizing multiple funding sources. Obviously, we're going to talk about quick rate. We think that should obviously be a pillar of any wholesale funding solution. But again, incorporating reciprocal deposit, public funds, broker deposits, understanding how those work and whether their availability will change, should anything adversely happen to the bank. But again, I think when times are good, certainly making sure you have access to multiple funding sources is important. So, maintain relationships with those providers. Again, I think, just day to day, it's easy to fall victim to just using one or two because it's a little bit easier. But I think, testing those on a regular basis is important. And then I think, as I just previously indicated, make sure we document and monitor factors that could impact your ability to raise funds in any of those offerings is important to know and to understand and to document. So, I think, again, where we are when things are good, we all understand, I think are easy to articulate our story. The challenge is always when you start to, identify or stress events that, we make sure we have some kind of early monitoring system or early warning system within a bank, to kind of understand when and where we might need to draw on some funds. You can certainly use a lot of, different indicators to monitor. Again, I know one of the things we always are is just kind of a forward-looking, ins and outs that's going to affect our cash. Looking at upcoming maturities of investments, borrowings, and just so we can have even beyond the month, but just a kind of a future look of what's going to be coming and going with growth for both loans and deposits, factoring into it. Just kind of gives you a good 10,000 foot level of where your liquidity might be, and then where and when you might need to plug in some of those wholesale funding sources. And then I think a healthy refresh on your CFP is important. Again, things change. Things that we felt like were normal maybe a year or two, 5 years ago, we want to make sure we're dusting off those contingency funding plans. I think one of the biggest challenges when we start talking about stress testing, is really, understanding what, unique risks or just in general risks, might trigger something or make us, again, be more reliant on wholesale funding. I think for a lot of institutions, again, I think just our ongoing business is creating some liquidity challenges, right? Loan growth is accelerating. Is our local market able to keep pace with that? In most instances, the answer is no, right? And so again, utilizing those wholesale funding sources, identifying how much of it's going to be used in the future for ongoing, just need, and then how much is still available for contingency events is important to understand and also to articulate. Again, I think not spending too much time trying to identify stress situations. I think just really understanding how much capacity you have, how much you're currently utilizing just for day to day. Again, understanding those distinctions, I think, are important as you not only track your activity but document your story. Some of those events that do pop up, and then I know institutions have used to incorporate, kind of listed here again, just inability to fund asset growth, funding maturing, unexpected withdrawals. Again, I think the thing we've seen because of Silicon Valley is, again, focusing on uninsured deposits, making sure you have wholesale funding sources to cover that is an important piece, and that you're monitoring those going forward. I'm going to take a question here that I saw pop up. I'm sorry I missed this earlier. Have you thought of developing a liquidity stress similar to your? Yes. So Mike, thanks for the question. This is something we have looked at. We have some ideas that we've put down together just kind of on the call report data. We're looking to enhance that a little bit before we release it, but it is something, yes, that we continue to monitor and work on, and hopefully we'll get something put together. Excuse me, but thank you for that question, Mike. Make sure I didn't miss it. Thoughts on asset sales as a strategy, right? So again, I think beyond is another question that came in, right? Beyond your bond portfolio, it's certainly a strategy. It's certainly not one I'd want to go to first. Certainly I think that's why we want to make sure, we can keep, as much cash as we need, but have multiple funding sources, get all that available, collateral pledge so that we can, have borrowings. For me, if we're talking about a bond sale, then that's kind of in the category. But if it's a straight asset sale, right, it's going to be lower on my list, just for a number of reasons, right? One, it's going to probably just be harder to get to come to fruition. So, the likelihood or the probability or the timing of which we need it's just going to be harder to ascertain. So again, bond sale, hopefully we can go to our portfolio there for if we're looking to do anything that's not underwater. But again, certainly an asset sale can be part of the strategy, but it's again, kind of if you think about it in a pyramid, it's going to be or just on a list, it's going to be lower on my list. So contingency funding plan, details, again, kind of as we're kind of talking around on the edges here, is how quickly can funds be available, right? I think that's really most important when we're thinking about these, is accessibility and availability, are critical as you're thinking about your wholesale sources or alternative sources. Again, if you are using the home loan bank or any of your other wholesale funding sources for ongoing liquidity, identifying again how much is available, how much is being segregated for ongoing activities, how much is going to be available to you for contingency events. I think again, just creating those distinctions, understanding those distinctions, articulating those distinctions are important. Making sure all of your lines are active and the collateral is good, understanding the terms, understanding if there are any issues on, in accessing funds, making sure you have, contact information and your staff identified, and then certainly, having tested those lines, hopefully within the last 12 months, if not sooner. Again, a good contingency funding plan is, it's clearly going to document roles and responsibilities, tolerances. It's going to, address the stress testing or the monitors that we were kind of, keeping tabs on before we activated. But I think just a healthy review is the best plan, right? I think whether we kind of, think about it just as reviewing our contingency funding plan or just our overall liquidity. I mean, that really is our lifeblood. And I think, just a healthy refresh, a little bit more frequently is important because it is kind of, just, it should be ever present because, there's certain stress events that we can plan for, but there's things that are just always going to occur that we didn't plan for. And so I think, having it be something that we're just kind of constantly monitoring and optimizing, I think is our best strategy. So, just a reminder in closing here, just on some next steps to kind of incorporate into, our overall liquidity management or our contingency funding plan, however you kind of articulate your story at the bank, right? Everybody's story is a little bit different. But these are just some reminders to certainly, if you haven't incorporated or thought about in the past, just to incorporate as well. Final thoughts and takeaway again, having your cash reserves at a level that you want is critical. Review those, management, policies. Make sure you're not restricting yourself in an adverse way. I can't emphasize enough monitoring your uninsured deposits. Know who those borrowers are. Make sure you have contingency funding, that can cover, any sudden or large withdrawals from those uninsured depositors. Confirm those, policies on a regular basis. Stress test, or at least think about stress testing or what type of stress events might have you change your mind, and then make sure you're communicating with your ALCO committee, your management teams, and your board, just to make sure everyone's on the same page when it comes to your bank's liquidity. So again, I think at this point we're going to kind of transition the conversation, right? Organic growth deposit growth is what we all are striving for. There are times when it's tougher than most, and that's why there's sources like QuickRate, right? We can help bridge some of those deposit challenges. At this point, I'm going to have Pam talk a little bit about the marketplace, some of the highlights, and then she's going to walk you through a demonstration as well. Pam?
Thank you, Sean. Okay, great. Thanks everyone for joining us today. First of all, on QuickRate, just to remind you, I think Sean may have mentioned it, but as a subscriber of QuickRate, if you belong to the marketplace, you can actually use QuickRate as much as you want on either side. So we're going to focus today on funding and banks bringing in deposits, but certainly know that you can also invest if you have excess funds you want to invest, or both. There's no limits to your usage here. So that is what your subscription provides. Marketplace, just a brief outline of who we are. We have been around since 1986. We have over 2,800 institutional subscribers on QuickRate, primarily made up of banks and credit unions of all sizes. We have a lot of tools within the marketplace. I'm going to show you a few. It's designed to be a totally paperless system, so we've put all the automation in there to make your jobs easier on either side. I'm also going to show you some of the current activity. I'm going to be logged in live, so you'll be able to see, you know, current rate environment, that sort of thing. But also, I'll show you where the current activity is by term and by position, that sort of thing. And then our, you know, customer service, our support that we offer, and the marketplace itself. We have excellent reviews from our customers. So, in fact, some of you may be our customers. So, you know, that's who we are. We are also recognized as an ICBA preferred service provider. We have been since 2002. So that's both Quick Rate, the company, and the Quick Rate marketplace itself. So that, you know, we're very proud of that, and we've maintained that, you know, all this time. Also, with a couple of our other products, Quick Analytics and IntelliCredit, are also ICBA preferred service solutions. Okay. Now I'm going to share my screen with you, and we're going to, as Sean said, do a brief walkthrough. I'm going to keep it pretty high level because, you know, I don't want to take up too much of your time today, but I just want to give you a feel for, you know, some of the automation that's built in, how it works, give you a better feel for, you know, what is the marketplace, how do you communicate with the other subscribers, and just to be able to help you see if it's a good fit or if it's something you want to learn more about. So as I mentioned, I am logged on live. I'm going to go to the first screen, which is view rates here. Now this screen is more for an investor. This is where your audience goes when they're wanting to place deposits in the marketplace that day. I think it's important for you to understand your audience. So that's why I want to bring you here as well. If you're looking at Quick Rate for funding, these institutional investors, they do break their portfolios up into the just below $250,000 pieces. So this is not a place where you might see large blocks like you might see through a broker or something. These investors want to stay within the FDIC insured amount when they're placing these CDs. The good news for you is you don't have to be the top rate to attract attention. You just have to be the next new face in line. In other words, when the investor comes in, they're not going to double place. In fact, we've entered a dummy portfolio here, investment portfolio, so that you can see what the investor sees. But any of these banks with the blue check mark to the investor, that means they've already got a deposit there. So they're going to skip over those looking for the next new face. The other thing I want to show you here is if the investor clicks on the bank name, so if this is your bank out here posting rates, this is the information provided to those investors. So obviously they'll know who you are, where you're located, your FDIC insurance number. You have to be FDIC insured to post a rate here. The specifics about how you pay your interest and also your minimum max deposit. This bank has elected to have $1 million max deposit, which you can certainly do. But again, I want to set the expectation. They're going to be those just under $250,000 pieces. How they pay their interest, including this bank is paying, by ACH only. You can do mail a check only. Some banks offer it either way, but you will let them know. The wire instructions. One of the other important things to understand is with Quick Rate is we are not involved in the transaction at all. You are working directly with these investors. So when they send you an inquiry, if you decide to accept that deposit, they're going to wire those funds directly to you. So you do provide them with your wire instructions. These are same-day transactions. There's no settlement period, anything like that, but the banks will put a cutoff time, a wire-in time. So this bank, they're in California, yes, so they have a pretty late wire-in time of 6 Eastern time, telling the investor, if you wire me those funds by 6, I'll book that CD as of today. Otherwise, it's going to be the following day. And then, of course, the same with the wire out time. And then just a brief financials. Brief financials on your bank is provided to the investors. You don't have to give us this. We get it directly from the FDIC, updated, you know, quarterly with your call report. So that's the information about your bank that is provided to the investors. Now, what the investors will do, I mentioned they're going to come in here and they're going to pick the next new face. So this bank, they would select this bank. If let's say they have $1 million, 4 pieces to place. This bank, and again, they're skipping over the blue check marks. They don't want to double place. Well, I was in here earlier. So once they finished, they said, that's what I want to place. We are sorted by the 1-year term. You can tell it's highlighted. They want to place these 4 CDs in a 1-year term. They're going to go to their rate card. And what I'm showing you now is just the communication between you and the investor. They're going to put the amount per investment. Then they're going to select, in this case example, they've selected 4 banks, 4 pieces they want to place. So they'll select those and they'll click send an inquiry. What happens when they do that is if you happen to be one of these banks they've selected to place a deposit with, once they send that inquiry, you will get an email notification from QuickRate that says you have an inquiry, log into QuickRate to reply to them. Nothing is conducted via email, just notifications. It's not a secure method. You'll always be prompted to log into QuickRate for any type of communication on either side. So once they send that inquiry, I'm going to go to a screenshot to show you what that looks like on your end. So you've gotten an email, it says you have an inquiry. So you go to your inquiry screen in QuickRate to respond to them. In this example, you've had 4 inquiries. We're going to respond to this first one, Flag Credit Union. Now, this is the information about the investor and also about the inquiry. So all of this will pre-fill from that inquiry, the date they're purchasing it, of course, the amount they want to place, the maturity date and rate from whatever you have posted in whatever term. You'll also, of course, know who the investor is, their tax ID number. If you're accepting, or I'm sorry, paying your interest in with ACH, you'll have their ACH instructions here. And then probably most importantly, their documentation. One of the nice things about QuickRate being a closed institutional marketplace, no consumers, no individuals, these banks and credit unions, because they're federally regulated institutions, they are exempt from the CIP requirements. So you'll need very little from them. You're going to want to have a W-9 and a corporate resolution, which will have, samples of the authorized signer's signatures. This is already attached before we flip the switch and allow them to start investing, sending inquiries. These documents have to be attached. So you don't have to chase these down or request them. They're already there. If you decide to accept their deposit, you already have what you need from them. In order to communicate with them, you just click accept. Of course, it's date and time stamped here. And then the investor on the other end will get an email that says you have a response. Log into QuickRate, to see that response. So now in this example, you can tell someone on your end has replied to the investor. Once they wire you those funds, again, we're not involved, they'll wire those directly to you. Once they wire you those funds, then you're going to want to, you'll put them on your core system for, your interest payments. You can enter a certificate number if you want, but you're going to want to remove them from your pending file because this is now complete. You've received the funds. So you're going to select them and click post and create safekeeping receipt. What that does is it takes it out of your pending inquiries because it's done, but it also creates the safekeeping receipt, which is the only thing you're going to have to provide to the investor. So this is just an example of that receipt. Customer service during your training, which usually lasts about an hour. It's really easy to get up and running, get set up, but you can upload your logo. All of this is a merged document. So QuickRate already knows who you are, who the investor is, the terms of the CD and the rate, how you pay your interest, because that'll also be set up during training. And then your early withdrawal penalty will be entered again during training. And once you do that once, you don't have to do it again. It's just part of this merge document. So just by clicking that button, you've created this for the investor on the other end. You don't have to email it or mail it or anything like that. What the investor is going to do is they're going to go to their investment portfolio within QuickRate and they'll just get it there, this little piece of paper with an S in it. That is the safekeeping receipt, meaning the bank has clicked the button. They've generated it so the investor can just go get it. So that's the really start to finish, the extent of the communication from the time, you post your rates, the investors come to you, wanting to place a deposit, you accept it, and they wire you the funds. Everything is done through QuickRate. Now, the next screen I want to show you is publish rates. So this is where you go, obviously, to publish your rates, but also to help determine where to set your rates. So I think I told you earlier that I wanted to, log you in live to see the current rate environment, but also the current activity. You'll notice on this page, there's this little post-it note. When you click on that, this is always going to provide you with the most recent activity. So we're in the month of July. So what it's displaying here is the month of June. So you can see by term, and these are all the standard terms, where was the activity last month? 1 year was the most popular term. Excuse me, it always has been. But there are plenty of other terms where there's been quite a bit of activity. So the reason this is important is so that you'll know, hey, I can be less aggressive in a 1 year term than I could be in one of these, like a 60-day term where there's just really very little activity. But you can drill down a little further. Was the 1 year money that came in, was it all just given to that top bank? Did anybody beneath the top rate get money? So we can drill down a little bit further. We're going into just the 1 year term for last month, and this screen will show you by position. When it refers to position, it's talking about the position on that page, the view rates page. The top bank is in position 1, the bank under them is in position 2, and so on. So you can see the different buckets here. This is the top 10, positions 1 through 10, positions 11 through 25. But even in the, greater than 50th position, so pretty far down the page, there was still activity. So this will help you kind of gauge, where should I set my rate? If we go into that, I think it was 60-day term that was not as popular, you can see that, well, there wasn't a whole lot of money placed there to begin with. It's just under 9 million in the top 10, just over 1 million in the 11 through 25. There's no activity in the lower, further down the page, if you will. So if you really want 60-day money, you're going to have to be in this top 10. So again, it's just to give you some insight before you post your rates as to where's the activity. One of the tools we have built in for you is this edit rates by market position. It's really the easiest way to determine what rate to put out there. What you see in this page are all the standard terms, the best term, meaning that top rate that's being offered right now, 10th rate, and so on. So in this screen, you can just tell Quick Rate what position you want to be. So in that 60-day term, let's say not a popular term, but you want some of that money, so we're going to put you in the 5th position. In these more popular terms, we're going to say 20th position. Because again, you don't need to be high. In a perfect world, you'll always have rates out here. You'll have your rates a little bit lower and you'll bring it in slowly, pay less for the deposits. But for our example, we're going to go 20th. Excuse me. So then you just click set position. What happens is Quick Rate will come back and it'll make a recommendation for you. It'll try to get you as close to that position as it can without leaving you tied with a lot. So this is probably a pretty good example. It's telling you to post to 4.101 in the 2-year term, but it's put you 15th. We asked to be 25th. The reason it's done that is because just a small amount, 100th of a basis point, in this case, jumped you 7 places up the page. So they're going to find you quicker. So that's why, it's not a bad idea to take the recommendation, just because it'll position you in a much better place, move you up the page on the view rate screen, and you've really paid nothing more for that deposit. You can analyze in here, as long as you want, but once you're happy with these rates, you're just going to have to do a couple things. You're going to have to set an end date. It defaults to a week because most of our banks post them once a week, but you can come in and out anytime and raise your rates, lower your rates in and out of the market every hour if you wanted to, but you don't have to monitor it that closely, but just know that you can. The other thing is you'll decide if you want a holding limit. There's a couple things Quick Rate will watch for you in the background and react however you want it to react. So first is by term. Let's say the 60-day term, you like that rate, but you really don't want any more than 2 million in that one term. If you set this by term, a holding limit, what Quick Rate will do is once you've reached that threshold, it'll do one of 3 things. It'll send you an email. It'll just remove this particular rate right from the market. Or you can say, well, I'll stay out there, but I want you to lower that rate by 50 basis points. I'll leave it out there. If I get one that cheap, I'll take it. The other thing you can do is set a holding limit by total. You can say, I don't care, what term these come in at, but if I get 10 million, I want Quick Rate to do one of 3 things: lower all my rates by 50 basis points, remove them all together, or just shoot me an email so I can come in and, address these rates and maybe make some changes. So that's one of the, a nice feature if you want it to watch it in the background for you. But once you've set that up and you're ready, you just click post and your rates are out there. So very much real time. The only other thing I'll mention on this page is the rollover rates. You can post rollover rates that will only be seen by those investors that already have a deposit with you. So in other words, you can segment your rates to different audiences. If maybe you're not even out on the main page, but you do want to retain those deposits that you already have, this is where you could post those rates to only be seen by those investors that you want. Okay, we have a couple more minutes. I'm going to just mention one other thing under resources. You have unlimited customer service, I've already mentioned. You also have unlimited, I'm sorry.
Pam? Sorry,
Yes,
could I interrupt you? We had a question come in. Could you go back and show them where you got the charts with the activity charts?
sure. That's in your published rates page. In this little post-it note, that's where you can see the current activity. So again, the first one is by term, how much came in for each term. And then you can drill down further here to see where within that term the activity happened. Hopefully that answers your question.
Perfect. Thank you.
Sure. So regulatory, you also have unlimited regulatory support. This is Debbie Walker. She's been with us almost since the very beginning, well over 30 years. She has written a risk management workbook and sample policy templates. There's no cost for that. It's only for subscribers, but if you would like those, if you are a subscriber, she'll send those to you. Can be real helpful, especially if you're adding rate listing service deposits as a new type of funding. It'll be helpful to update your policies. There's also a lot of information out here, kind of frequently asked questions. What are these considered non-brokered? Which yes, they are, but she tells you exactly why that is. USA Patriot Act. Why are these investors, these banks and credit unions exempt from the CIP? Where do these go on the call report? She tells you exactly which field here. So there's just a lot of information, but if you have any questions or just want to talk with her, she's always available and she's great. And I think that's all we have time for. So Sean, I will pass it back to you.
All right. Thank you, Pam. Let me get this back up here.
Oh, I did forget to mention, if you have an interest in finding out more, like I said, we stayed very high level. Sean will show you some contact info, but just reach out to us via email. You can call us. There's actually a form on our website where you can schedule a demo, but we'd be happy to contact you and provide you with whatever you need and schedule a one-on-one demo if you like.
Absolutely. Thank you, Pam. So just as a reminder, again, we talked about the marketplace today. Obviously, we have Quick Analytics where we do a number of different things many of you are probably aware of, but it includes, bank and peer performance as a CECL solver product, and then, in-depth interactive bank analysis pages on all banks in the country. For those of you who aren't familiar with our IntelliCredit division, we provide loan review, but we also provide software that you can use internally for your own loan reviews and annual reviews, a portfolio analyzer tool, and then as a third party, we will do external loan reviews and have a loan level stress testing capability, both again as a service, but also in the future here, very near future as a product. Certainly any questions, I think, please go ahead and submit those now. We'll certainly, I'll monitor those and take those. Finally, coming up tomorrow, we have another webinar offered by our Infusion marketing team, how marketing fuels your bank's growth plan, July 24th at 11 Eastern. With all these webinars, I encourage you to register. You will always receive a link to the recording and a copy of the slides if you register, even if you don't attend. So highly encourage you to register for all of these. And then on August 1st, we will have a couple of bankers come on with Steve Huntington and myself to discuss how they use Quick Analytics within their own institution and kind of in their daily life. So we felt like that might be a nice complement to, instead of hearing Steve and I talk for a change, we'll actually bring some bankers on to explain how they use and value Quick Analytics. I don't see any additional questions. So as Pam indicated, right, we'd love to talk to you more about QuickRate. Set up a one-on-one so you can certainly schedule your demo at quickrate.com. but we can talk about, pricing, just walk through the marketplace in some greater detail. So certainly encourage you to do that. Without any further questions, again, I want to thank you for joining us today. As you can see, you can always give us a call. You can email us at info@quickrate.com. But really appreciate you taking the time out of your busy day to join us. If there's anything we didn't discuss today or answer for you, again, reach out to me or Pam, and we would welcome the opportunity to discuss anything else in further. But without any further questions, again, thank you all very much for joining us, and we hope to see you again in the near future on a Quick Rate or Quick Analytics or IntelliCredit or Infusion Marketing webinar. So thank you all very much and have a great day.
Thanks, everyone.